Hey guys, welcome back to another edition of the Swyftx Cork. It's me here, Pav, lead market analyst here at Swyftx. And today we're going to dive into some of the more leading metrics in the market that I think are worth paying attention to this week. Just to reiterate from last week, if you did miss out on that particular write-up and video, we talked about how inflation outcomes may be potentially a little bit pricing in to be too comfortable. And we did see a miss with the most recent US inflation metrics. So if you haven't catch that article, make sure you go check it out just to understand what we're talking about there and how that relates back to the crypto markets. But the key takeaway is that we did see inflation drop. And we also saw the key metrics that we show how the market's thinking about inflation also take a bit of a dive as well. So again, that sort of sets up this nice little picture that maybe inflation isn't as bad as what the market is expecting. So I wanted to take what we did last week and parlay that into something about, okay, what else can we look at in terms of a macro factor as a way to think about the crypto markets while we're still potentially just sitting here and range bound. Like, I know we did see double digit gains across the altcoins this week, but we're still waiting to see if this is going to be a durable shift. Is this just a flash in the pan? Or are we going to potentially start to see a shift in the way people are perceiving risk right now? Because right now we're still seeing what we're going to talk about today, sentiment at all-time lows. So I want to double click on that idea of sentiment being low and really go into that a little bit further. Now, when we're talking sentiment, particularly in this instant for today, we're going to talk consumer sentiment, consumer stress. But we're going to focus specifically on the US, but this is a story and narrative that's pretty true across most major economies right now, including Australia. But there are metrics out there that measure how is the average punter doing right now, right? So we're going to dive through all of that because at the end of the day, it is a consumer that leads to, in the US at least, about 70% of their gross domestic product. So the productivity and growth within a country. Now, this is important because we look at crypto and risk assets in general. They are very sensitive to growth periods. We can see the market's done really well when the market has seen growth, like such as out of the COVID crash and the market being stimulated and reopening. We saw crypto markets do really well in 2021. But we also see the net result of 2022 when everything was being wound back a little bit. So without dancing around it too much, let's dive into this picture of what's driving consumer sentiment right now, because the headline metric really that we have is consumer sentiment. It's really in the pits. It's been at levels in the US, we haven't seen since 2022. Now, this is an index survey done by Michigan State University. It's the most referenced indicator or material that's out there in the market. It's considered by consensus to be, that solid figure of measuring the benchmark of consumer sentiment. So what we have is consumer sentiment sitting at about 52.9, again, just moving at those historical lows. But we can also tie into, okay, what's feeding into that sentiment being poor right now? And when we look at metrics like the personal saving rate in the US, that's sitting about 3.5%. So that's that red line that you can see. When we look at historical lows, again, we're sitting at those same levels that have been pretty much synonymous with poor sentiment in the market as well. So people are essentially not saving right now. Now, we also tie that into what's known as consumer debt service levels. Now, the best way to think about this is if you're a person, you have obligations such as loans, mortgages, credit card debts, uni debts, higher education debts, etc. They're all obligations that you need to meet where a lot of your income is already allocated before you can even go and spend it in the real economy, right? So what this ratio basically does is it quantifies how much of the income is already put aside for debt's obligation. And again, you can see there the orange line, it's sitting about 5.37%. We have seen it higher in the back end of the 20 teens, but right now we are seeing it at relative highs across the last 4 years. Now, another kicker to add to all of this is what we saw out of the news earlier this week, which was a revision of US growth in their labor market. Now, again, if we're going to see the market to have more money to spend, we want to see productivity boom. We want to see more jobs in the economy. We just saw what the market thought was the employment number get revised last week, revised down for the year of 2025 through to March. So again, when we start to pay these things all together, maybe things are not as great as what the market was expecting. It's going to be interesting to see how the market reacts now, knowing what it knows. And again, we're not pointing to any sort of crisis here. We're not pointing to that we're in an imminent collapse and we're basically standing here at COVID round 2.0. That's not what we're saying. But what we're basically saying is when we're trying to understand why are consumers potentially not feeling the urge to jump into instruments like crypto, which again, people need to have the spare cash to be able to invest in crypto. This kind of does help paint that story to understand how the average person is doing right now. But the other way to view this as well, if you did want to take a counter view, is while we are potentially at absolute lows for consumer sentiment. The last time we were here in 2022, when we're just looking at this metric alone, Bitcoin was basically creating its bottom. It did take many months and months for that to happen, but we did see that to be, now looking back in hindsight, to be one of the better periods to purchase the asset. Now, this is not to say that it's an invitation to purchase Bitcoin, but again, it's more of a call out that if we were to roll back the clock, if we were back in those same market conditions and environments, what would you have done different, right? Like, it's just a good chance for us to all reflect. Now, that's all the Now, on the flip side, we can look at this data and acknowledge while sentiment is quite bad, we are again at those levels for consumer sentiment, the blue line that we haven't seen since 2022. And what that really sets up as a framework or way of thinking when it comes to the crypto markets is really the bottoms of the market were made during the periods where sentiment was quite low. At the same course, crypto market highs were basically produced when sentiment was quite high, as we can see there now in hindsight, 2024. That's where those highs were put in, very similar to the crypto market as well. Now, this isn't to say this is the bottom or this is where the bottom's going to be, but historically, it has been during these conditions that has produced mass selling. We usually have seen seller exhaustion. We do start to see, once maybe sentiment starting to recover, maybe in some of these input metrics that feed into consumer sentiment, they could be very much well worth tracking, and also the policy direction as well. If the government policymakers see this as a real issue, they will pivot policy to be more accommodative. And this will be that lagging effect metric that moves afterwards as well. So again, it's all that's just that just single story that we're trying to put together. But yeah, really just want to help everyone understand the markets are going down. Why aren't we going up? History shows us that if we look at why people may not be purchasing crypto right now, because everyone is to a degree struggling to very similar levels as 2022. But that's it from me here at Swyftx. We'll catch you again next week. Cheers, guys.